Sorry. Very good morning, friends. Today we are going to discuss a new course of management program, that is Working Capital Management. I am ASEEM Kumar. I will be presenting the requisite information about working capital management in today's and forthcoming sessions. Friends, for MMPF001 working capital, we are having 4 blocks. The first block consists of concepts and determination of working capital. Block 2 speaks about management of current assets. Block 3 speaks about financing of working capital. And block 4 would be elaborating about working capital management issues and practices. Today we are going to cover block 1, the concept and determination. We are going to cover the conceptual framework, unit number 1. Unit number 2, about the operating environment of working capital. And unit number 3, the determination of working capital. We'll start with unit number 1, conceptual framework. Definition of working capital. What is working capital? It is for your daily routine, whatever you are supposed to spend is coming through working capital. You may be investing somewhere and somebody may be investing in you organization. That's how the difference of this is the working capital. Now let's just look at the definition as well. Working capital may be defined in 2 ways, either as the total of current assets or as the difference between the total of current assets and total of current liabilities. But most other financial terms, the concept of working capital is used in different connotations by different writers. Thus, there emerge the following 2 concepts of working capital. The 1, gross concept of working capital, and 2, the net concept of working capital. The gross concept, we have to just leave. No special distinction is made between the terms total current assets and working capital by authors like Mehta, Archer, Bogen, Miar, and Baker. According to them, working capital is nothing but the total of current assets for the following reason. First, the profits are earned with the help of the assets which are partly fixed and partly current. Logic then demands that the current asset should be taken to mean the working capital of the corporation. Number 2, with every increase in funds, the gross working capital will increase. With every increase in the funds. It's a wider definition altogether. But when we have already discussed that it is partly fixed and partly current, so we are going to take only the current assets and current liabilities. The management is more concerned with the total current assets as they constitute the total funds available for operating purposes. Friends, when you have to just look at the business operations, so you need funds for the operating purposes. And that's what the management is more concerned about, that how much total current assets we have. The net concept of working capital had relevance when the form of organization was single, entrepreneurship, or partnership. Where you, of course, there are many things you may not be just able to just differentiate, and therefore in the sole proprietorship or single entrepreneurship or partnership concerns, you will be finding out the concept of working capital had relevance. Net concept of working capital would be applicable, but whereas when you are just talking about the bigger organization and company's culture, then you have to just go for the gross concept of it. Net concept. Contrary to the aforesaid point of view, writers like Smith, Gutman, and Dougal, Harvard, and Gross consider working capital as mere difference between the current assets and current liabilities. The difference between the current assets and current liabilities. According to Keith V. Smith, a broader view of working capital would also include current liabilities such as accounts payable, notes payable, and other accruals. Friends, the writers, they are advocating the net concept for the following reasons. In the long run, what matters is the surplus of current assets over current liabilities. This is one of the other school of thought, which is just saying, yes, it is the long run, what matters is the surplus of current assets over current liabilities. It is this concept which helps creditors and investors to judge the financial soundness of the enterprise. There you just come to know how sound you are, whether your ratio comes out to be 2:1, or whether it is with the liquid asset, it comes out to be 1:1, which definitely comes out to be the parameters of financial soundness. What can always be relied upon to meet the contingencies is the excess of current assets over current liabilities. Since it is not to be returned, it is not a loan, it is not a sort of advance, it is not a kind of, say, the shares which are to be returned in company's lifetime. Next is this definition helps to find out the correct financial position of companies having the same amount of current assets. Okay. Now, the current financial position, you can just get it with the same amount of current assets. That means the liabilities and the current assets, once we are just in know of it, we will be in a position to know the correct financial position of the companies, how much we own and how much we owe. Constitutive of working capital, current assets, the following are listed by the company as current assets. What is that? Inventories. Inventories could be of raw material, it could be of work in progress, it could be other tools and miscellaneous spares, and it could be finished goods. In the sundry debtors, you will be finding out the sale debtors, you will be having some bills receivables, and so on. For the cash and bank balances, the name itself gives you the idea. The cash and the bank balances are the clear liquid assets you have. So therefore, the current assets include cash and balances as its constituent. Next is loans and advances. Once we just speak about the loans and advances, these loans and advances are not for a longer period. All these loans and advances are as far as possible for a shorter period, less than 1 year. If you are giving any advances also to the employees, there are many other things you are taking care of, thereby going for the short-term loans and advances. Current liabilities. When we speak about the current liabilities, these are the liabilities which are just there on your head as short-term O's. Why short-term O's? Because the current liability which you are including under this category is because of the creditors, because of the small advances are given to you. So these are to be settled, of course, at the earliest less than a year. If it is more, definitely the nomenclature could be something else. Short-term credit. Short-term credit, other than the advances on account of, say, your raw material, finished goods or tools and spares, you are getting some money advances also. Short-term credit, you get it on something which is called the current liability. Thereafter comes the provisions. Now, friends, for the provision, when you just prepare your trial balance, thereafter you have to just summarize the financial statements. In summarizing the financial statement, you get to know about what are the pending provisions, what are the pending expenses you have, which could provide for the financial year as accrual entry. It could be for the outstanding expenses. It could be for outstanding taxations. It could be for outstanding dividend and so on. So all those provisions you are making at the end of the financial year, making making an accrual for the expenditure relevant to that particular financial year. Types of working capital. See, sometimes, not always, sometimes working capital is divided. Normally, working capital is the stuff which is just being used for everyday work. But there are some philosophical thoughts also. Sometimes you say that working capital is divided into two varieties. First, the permanent working capital. Second, the variable working capital. Friends, for the permanent working capital, though working capital has a limited life, less than a year, not exceeding a year, in actual practice, some part of investment that is always permanent. How? Since firms have relatively longer life and production does not stop at the end of a particular accounting period. So you don't stop your production at the end of the financial year. You keep on going. You may be buying the things even on 31st March. So what do you do? The connotation is that you have some investment is always locked up in the form of raw material, work in progress, finished stocks, book debts, and cash. It will never be nil. So the investment in the current assets or working capital would also be called as plus balance working capital. If it is minus, definitely it is a danger. Variable working capital. You don't need it always. What do you do? It is a transitory working capital. This is also known as the circulating or transitory working capital. How? This is the amount of investment required to take care of the fluctuations in the business activity. While permanent working capital is meant to take care of the minimum investment in various current assets, variable working capital is expected to take care of the peaks in the business activity. While investment in the permanent portion can be predicted with some probability, investment in the variable portion of working capital cannot be predicted easily as sudden changes in the business activity cause the variation in this portion of working capital. So we could say that the variable working capital is a kind of contingency working capital which is needed at the time of peak or some sudden change, thereby giving you an additional need of funds which are arranged through variable working capital wherever it has been invested. Cyclical flow and characteristics of working capital. Friends, it depends upon the business what kind of working capital you will need and where you will be needed. Let us just look at it. For every business enterprise, there will be a natural cycle of activity. Due to the interaction of the various forces affecting the working capital, It transforms and moves from one to the other. The role of the financial manager then is to ensure that the flow proceeds through different working capital stages at an effective rate and at the appropriate time. However, the successive movement in this cycle will be different from one enterprises to another based on the nature of the enterprises. For example, if the enterprise is a manufacturing concern, now look at it. The cycle will run something like cash, buying raw material, finished goods, sales on credit, accounts receivable, cash. How you just spend the money, how you just make the finished goods, how you just sell the goods on credit, you create the debtors and collecting the cash from them. But if suppose the enterprise is purely a retailing company, then you know what happens? Which has no manufacturing problem, the cycle is shortened. How? Cash, where you are just doing it, merchandise you are purchasing, then sales, you are having accounts receivable, then collections, you have cash. So you are buying the goods and then selling them off. On credit, then you collect cash. If it is cash, of course, cash is already there. On sale only. But if the enterprise is purely financing enterprises, then the cycle is still shorter. What will happen? You sanction of loan, debtor. You collect the money periodically and you maintain the cash balance for sanction of other loans in routine. So it is further shortened because there are only three activities. One is giving money and the other one is collecting money. In both the transactions, the cash giving and cash receiving is a common factor because cash, say, movement is going on. But in real business situation, the cyclical flow of working capital is not simple. It may be either of three, it may be two of three, it may be all the three. Okay? And smooth going as one may be tempted to conclude from these simple flows. The cyclical process is repeated again and again, and so do the values keep on changing as they move through the cash to cash path. Okay? There are three important characteristics of working capital, namely short lifespan, swift transformation, interrelated asset forms, and synchronization of activity levels. Okay? Once we just look at the first important characteristic of working capital, there we come to know about the short lifespan. The short lifespan. Okay? With the short lifespan, if you just speak to, the component of working capital are short-lived. Typically, their lifespan does not exceed 1 year. Typically, their lifespan does not exceed 1 year. In practice, however, some assets that violate this criteria are still classified as current assets. There may be certain debtors who are promising, then you are just keeping them as the active debtors, or they may be giving you certain, say, momentum, thereby you are keeping them beyond the limit of 1 year. Okay? So these are violating, still we just classify them as current asset because in any case we cannot just put them under fixed asset. The nomenclature gets changed drastically. Swift transformation and interrelated asset forms. In addition to their short span of life, each component of the current asset is swiftly transformed into the other assets. Thus, cash is utilized to replenish inventories. Inventories are diminished when sales occur. The augment of accounts receivable and collection of accounts receivable increases cash balances once again. So it is a cycle. When your cash is used for purchasing the inventories are converting into sales, the sales are creating some receivables, and from receivables you get the cash collected. It is increasing the cash balance once again. Okay, the interrelated asset forms. So a natural corollary of this quick transformation is the frequent and repetitive decision that affect the level of working capital and the close interaction that exist among the members of the family of working capital. The latter entails the assumption that efficient management of one asset cannot be undertaken without simultaneous consideration of other assets. Asset forms and synchronization of activity levels. A third characteristic is working capital component is that their lifespan depends upon the extent to which the basic activity like production, distribution, collection are non-instantaneous and unsynchronized. Unsynchronized. If these three activities are only instantaneous and synchronized, the management of working capital would obviously be a trivial problem. If production and sales are synchronized, there would be no need to have inventory. Similarly, when all customers pay cash, management of accounts receivable would become unnecessary. Okay, so there is some level of unsynchronization, non-instantaneous. Thereby, we are just getting the stock, the creation of stock, and the receivables from the time to time in a moving industry. Friends, how do you plan for working capital? Planning provides a logical starting point for many of the decisions. It is very much true for working capital decisions also. Unless we plan for procurement and effective use, we will not be in a position to get best out of working capital. So what are the tools of planning for working capital? It should be interesting to know how to identify the relevant tools for completing the planning exercise. Treating the planning for working capital as part of financial planning, we can note down the following tools of analysis with respect to time frame. We may be having the short-term planning of a financial year or something like that, which is dealt with the cash budgeting. The medium-term planning, determination of appropriate level of working capital items, and long-term planning, projected payouts and return to shareholders in terms of CVP and fund flow analysis. We look at the most common thing is short-term planning, cash budgeting. A cash budgeting is a comparison of estimated cash flow and outflow, cash inflows and outflows for a particular period, such as a day or a week, a month, a quarter, or year. Typically, cash budget is designed to cover 1 year period, and the period is subdivided into different intervals. The budgeting process begins with the beginning balance to which are added expected receipts. This amount is reached by multiplying expected cash receipt by the probability distribution that will prevail during the budgetary period. If outlays exceed the beginning balance plus anticipated receipt, The difference must be financed from external sources. Outlays means expenditure. If your outflow is more than the inflow, then definitely you have to arrange the sources from external sources. The preparation of cash budget helps the management in many ways. Management will be able to ward off the disadvantages of excessive liquidity, since there will be information on how and when such cash results in. Of the several methods of preparing the cash budget, receipt and payment method is the most popular among many undertakings. Since the whole of budgetary structure is divided into revenue budget, expenditure budget, and cash budget was prepared by the organization by borrowing figures from various other budgets, such as the following. Production budget. If you are a manufacturing organization, the production budget. Otherwise, it will be a purchase budget. Then sales budget, how much you are expected to have, the sale quotient, the cost of production estimates with its necessary subdivision, for example, material purchase estimates, labor and personal estimates, and plant maintenance estimates. Fourth is manpower budget, the labor budget, the township and welfare estimates, profits and loss estimates, capital expenditure budget. Thus, cash budget is prepared as a mean of identifying the past cash flows and determine the future course of action. Cash budget generally are prepared by all enterprises on yearly basis, having monthly breakups. Monthly breakups are just for your monitoring purposes, so that at least you are in know of it, how much you have spent and how much is remaining in your budget. After doing the short-term planning, let us just go for the medium-term planning. Okay. What is there in the medium-term planning? In the medium term, determining appropriate level of working capital is considered a focal point. There are following three approaches to determine optimum investment in working capital. Industrial norm approach. What could be the industry norm? You may be following something and that is followed by others as well. And then it becomes a discipline in the entire industry. So that it becomes a sort of industrial norm. People are just finding out that it is a matter of practice in the entire industry. It's called industrial norm approach. Then economic modeling approach, because you cannot just run out of the race. Your competitor must be watching you with close monitoring. So thereby you have to run, you have to move, you have to manage within that industrial norm approach. Economic modeling, you may be having different models under which you have to work and you have to just move along. So those models you have to just follow in the event of contingencies or for the longer term. Strategic choice is neither the industry norm nor the economic modeling. It is something else. It is a contingency plan. It is a contingency plan which has been taken care of looking at the prevalent condition at that time. Prevalent condition at that time. So it could be different in each situation, or it could be similar in some situation. It could be majorly similar to something. It may be partial similar in some, say, situations. When we just go for the long-term planning, CYP analysis is one of the important measures. As a measure of long-term planning, macro level techniques like CYP, CVP and the funds Flow are considered helpful in making cost volume profits. Cost volume profits. So these are helpful not only for working capital planning but also for the entire financial planning. Okay, because you are in a position to know about how much cost it would be, how much volume you have to go for, and then how you are going to have the profits out of these two portions. Funds flow. Funds flow is yet another tool used in the long run to analyze the financial position of the company. Though the term funds can be understood to include all financial resources, preparation of fund flow statement on working capital basis are more common in finance. The preparation of such flow statement gives an idea as to the movement of funds in the organization. Working capital and inflation. You see how inflation is impact impactful on the working capital. The impact of inflation on working capital could be understood in the following manner. Size of working capital. Inflation causes a spurt in the prices of input. Factors like raw material, labor, fuel, power, even though there is no increase in the quantum of such input factor used. Secondly, inflation causes a spurt in the prices of input. Factors like raw material, labor, fuel, power, even though there is no increase in the quantum of such input factor used.